Hello, everyone. It is Sunday, October 17th, and this is episode 35 of Odds Are, your S&P 500 weekly market forecast. All right, let's take a look at last week. So, last week we made a projection. We said that there's a 97% chance that we would actually have a breach of one of the breach points, right? So it was very, very high, and that was because in the week preceding, we did not have a breach of one of those breach points. So, did we actually have a breach? You better believe it. Now, it wasn't the one that we thought was going to get breached, right? So remember, breach points don't have a directional bias. When the odds are, 81%, that's just that we're going to have a breach of one of those two breach points, the upper or the lower. But if you remember, we were looking at this midline and we said if the midline acts as resistance, right, and rejects and the price, so where the price goes up and then comes back down, then we thought we were going to breach that lower breach point of 42.92. Now, the market did a pretty good job at, kind of faking us out here. So the price went up. You could see here it went up to the midline, looked like it was going to get rejected. We had 3 down days right after it had breached that midline, and then it just turned right back around and skyrocketed to the moon. So we did not get a true rejection of the midline. That was kind of like a false breakout to the downside. And what ended up happening was we ended up coming right back up to the midline, going right past it. But this is where it gets interesting. Look where we stopped. So we identified a previous pattern where the market would cross to the downside. And you can actually see two instances here. If you look to the left of the chart, you see two instances where the price actually went down below the midline, went all the way down to the edge of the Bollinger Band, and then bounced back up and continued its upward momentum. So could we be looking at a similar situation, but just on the inverse, to where the market blew past the midline, right? So it breached the midline to the top side, went all the way to the edge of the Bollinger Band, but this time it's the upper end of the Bollinger Band. And what comes next is we come back down below the midline and then get back into that channel below the midline and stuck between the midline and the lower end of the Bollinger Band. So that is what the opposite would look like if we're switching the same pattern that existed before when we were in bullish territory now into more a bearish trend where we still have these breaches. But that's kind of like the pattern that may very well evolve here. But either way, we had a very high probability of breach. We did close we closed above the upper settlement limit. So we technically closed just outside the expected settlement range, which was 44.57 down to 42.60, and we closed up at around 44.63. So we actually closed outside of that range, which that doesn't happen very often. But again, about 21% of the time it does happen, so not a huge surprise there. Didn't come even close to the 45 parabolic SAR level. So that's kind of what happened last week. All right, looking at the moving averages, we did flip back to neutral on the short term. So that upward swing was enough to change the short-term moving averages into a neutral territory, and then still bullish on the medium term and long term. And then this is what we're looking at for next week. So for next week, we're looking at breach points at 43.65 on the downside and 45.15 on the top side. And then look at how close the upper settlement limit is to the parabolic SAR, literally 1 point apart, right? So that 45.42 and 45.41. Now, this is just looking at the numbers. I know we have some like upward momentum on this, but it is very, very, very rare. In fact, it's only happened 5 times in the last 20 years that we've had 2 back-to-back weeks where we settled outside of the settlement limit, right? So that's kind of just for perspective. It could happen, but it's very, very rare. So I don't think we're going to close above 45.42 by the end of this week coming up, which also means we're not going to close above 45.41, which is the parabolic SAR. So we're not going to be switching back into that bullish mindset based on the parabolic SAR. So looking at this, we still have now a 79% chance of reaching one of those 2 breach points if that pattern holds true, where we reach the top of the Bollinger Band and that acts as resistance and we go back down, then we'd be looking at the 43.65 breach point. But these are the numbers for next week. And let's put this now into the relative view here for you. So again, you can see what I'm talking about. You see how we are at the top end of that blue channel there. And so that could act as natural resistance, pushing us back down with the magnet effect towards the red midline of the Bollinger Band. And that's pretty much where the lower breach point is. So there we go. If we get that return back to the midline, then it would definitely make more sense for us to breach the 43.65 breach point. So maybe a good put buying opportunity for the weekly options, but that's what we're looking at for this week coming up. All right, and now if you didn't see that one coming, all right, so last week we said if the midline rejects it, it's going to go down. We got a little bit of fake out, and then it kept going up, and now we're seeing this Bollinger Band keep coming into play, right? There's a reason why we have this, and we demonstrate it on the charts. So for next week, do not be surprised if we end up getting resistance at that upper end, like we just mentioned, and if we go back down towards that midline. That is, the projection this week. I'm saying we're going to breach the lower breach point. So don't be surprised. Don't say you didn't see that one coming. All right, and we're going to wrap up with a quote by someone who's definitely not a trader and who many of you out there may have very, mixed emotions about. There are some people that love him, some people that hate him, and some people that just really don't care. But either way, you cannot deny that Mark Zuckerberg is a almost household name now and has been very influential. And whether you agree with how he achieved his success, has reached a level of success in business that is rarely attained. So Mr. Mark Zuckerberg has a quote here that I think is interesting for us. And he says, "The biggest risk is not taking a risk. In a world that's changing really quickly, the only strategy that is guaranteed to fail is not taking risks." Now, obviously, you can see how this applies to trading, but it's interesting that this quote, because it comes from someone who's an entrepreneur, not a trader, I think it's a great opportunity to reflect and remind ourselves that if you are trading, right, you're actually not that far off from, what the typical definition is of an entrepreneur. You are taking capital, you're taking resources, you're investing your time, your energy, you're refining your knowledge base, your craft. You are doing all this in an effort to basically make a profit. So you've got resources that you're dedicating, time and energy, you're putting it into work, and you're hoping to make a profit. Guess what? You're in business, the business of trading. And there's so much that we can take away from traditional business management principles and things like that that can help you become a better trader. So that's something we can explore in future quotes and future episodes. But I just thought this one was really, really cool, and it just reminds us that in life we have to be willing to take that chance, because if we don't, then we will be sitting on the sideline. And on the trading perspective, then we could say, hey, inflation, right? The cost of money, inflation is going to eat us away if we're not actually out there trying to put our money to work for us. So go ahead and make that money your employee, get your return on your investment, and have a great week. I will see you guys here next Sunday.